morning, and thank you all for getting up early and spending the Saturday here. My name is Larry Baker, and I work with Farmers Insurance. But in addition to Farmers Insurance, I do a lot of different, I work with a lot of different other carriers as well. So I usually, specifically with the DSALA, I work with different families to help them to fund their special needs trusts. Because if you have a child with Down syndrome, autism, whatever, you're going to want to put together a special needs trust, and you're going to need to be able to fund that trust with, when you're not around. So that's what I help to design for people. I've been in insurance now with farmers for about 7 years now, and overall in insurance about 10 years. I started off doing a lot of health insurance stuff. So that's a little bit about me, and that's ready to go.
Yeah, you also have a son with Down syndrome? Yes.
I also have a son with Down syndrome, and that's true. I have a son with Down syndrome, and he shares my name. So most definitely, all the things that you've gone through with, your children with Down syndrome, I mean, I've done as well. So, been involved with DSLA for pretty much all of my son's life. So, going on a little bit over 25 years now. Okay.
Are you able
So,
to share? Yeah, are you able to share your screen?
yeah, so let me go ahead and get this loaded up. Okay, so is everybody able to see that?
Yes.
Okay. So basically, what I want to talk to you a little bit about today is life insurance that you can use to build wealth while you're still alive. Because everybody has their own conceptions about life insurance. I'd like to structure policies that are going to be beneficial to you and that you could use. Okay, so we have a few people coming in. So basically, why does life insurance matter? Life insurance, as you see, it offers a protection to people. I mean, if anything's were to happen to you and you pass away, then the proceeds go to your beneficiaries. So that's all life insurance policies. But for most people, it kind of stops there. They don't know that you can have a policy that you can access the funds while you're still alive, and you can have a policy that will help to grow your funds while you're still alive. And once again, for the people that came in, if I'm going too fast, slow me down, ask me questions. You can stop me in the middle and ask questions. So traditionally, people know about term life insurance, and that's mostly what people look at. Those are the things that's mostly advertised out there. Term life insurance is for whatever, term period. It could be for 10 years, it could be for 20 years, it could be for 30 years. Um, the thing about it is, say you get to the end of that policy and you're still around, which is great. Most people think the policy ends. That's not actually true. Most policies at that point continue on, but every year after that, then the policy premiums will keep going up. So you can't really outlive it, but it can rapidly become unaffordable if you go past that policy period. and there's no cash value or anything in those policies. Now, so what if you had a policy that could grow your money and you could use it while you're living? So the we have another type of policy here called an index universal life policy. Okay, and if we want to dig into the index universal life policy a little bit more, it's permanent life insurance. So it's set up to last for your entire lifetime. Basically, if it's structured correctly, you should never run out of funds in that. And the cash value will grow over time. So we're going to dig into a little bit more about cash value. This is that same policy. If you've ever seen those videos out there that say like, be your own bank and things like that, that's this policy. So the cash value in the index universal life policy is linked to the stock market. It's linked to different funds, like say a fund. A fund is basically a bunch of stocks that are grouped together, and it's linked usually to like the S&P 500 or other funds like that. So when the stock market goes up, the cash value amount in the policy also goes up. But you also have protection, say like if the market is down. So it's a fairly safe product. Your money, it's tied to that index or that fund, so it's not really invested directly into the stock market. So there's a protection floor. Usually that protection floor is zero. So if the market goes negative, then you're not going to lose money. But if the market goes up, you will make money. So think about it like stairs, So when the market goes up, the policy value goes up or the cash value goes up. And if the market is down, it's going to level off and then it's going to go up when the market goes up. So that's how it's going to increase over time. Now, you can access the money or the cash value portion of the IUL in loans. Loans are tax free. So if you ever get like a second mortgage or line of credit, all of those funds are tax free. So the same as this. If you access the money in the form of a loan, then yes, the money that you take out of the policy will be tax free. And the great thing is that there's no restrictions on it. I mean, there's no age restrictions, there's no credit checks or anything like that. I mean, as long as there's a cash value amount in the policy, you have access to those funds. Now, I'm going to talk a little bit about loans a little bit later and what they mean because sometimes people are like, "Ooh, loans. No, I don't want to do that." So some of the common ways that people use the funds from the cash value is, they use it as a supplement to their retirement fund, or they have emergency backup money, or college funds, or funding special needs trust you could do. But in all honesty, you could use the funds any way you want. There are no restrictions as to how you can use the funds in that policy. There's not going to be anybody that says, well, you must use it for this. No, you can use them any way you want to. And there's tax advantages there because the cash value that's inside of the IUL grows tax deferred. So basically what that means is that say like you get to a certain point and you want to cash out the whole policy. And you say, okay, I want all of the funds that are available at one shot. Then at that point, you're going to be taxed because that creates a taxable event. And usually, when people are taking money out, I usually advise them to take money out, but leave some money there, so that way you don't create that taxable event. But if you do, it's tax deferred, so you will be taxed at that point when you take all the money out, not when you first started the policy. And again, like any life insurance policy in the state of California, the proceeds from the death benefit are always tax-free to your beneficiaries. So let's look at an example. 32-year-old male, $100 a month for 20 years. Okay. Year one, you're paying $100 a month for 12 months. That's $1,200. So you can see the age and the cumulative, so after 5 years, you've paid in, cumulatively $6,000. And you can see that cash value amount, that amount that's in bold there is increasing. That's the amount that you have access to that you can take out loans against. Now, you can see now, I only put 20 years because I don't see the point in paying for a life insurance policy forever. I'd like to go ahead and cut them off at a certain point because after a certain point, you're going to have enough in that policy that it's going to continue to grow on its own due to the interest rates and everything. And as a matter of fact, if you look at it at 20 years, you've paid cumulatively $24,000, but you made $28,000. So now you're about $4,000 ahead in that policy. So if you were to say to cash out that policy at that point, you made about like, $4,000. Also, if you go ahead and just hold on to that policy until retirement, then fine. Now you're sitting at about maybe somewhere between 70 and $80,000 that you have that you could use, to supplement your retirement. Again, you've stopped paying this thing after 20 years. So all it's doing now is accumulating money on its own. You can continue to pay into it if you want to, but that's really up to you. I don't suggest that you do it. I mean, because it will continue to grow on its own. So instead of $100 a month, what if we were to double that and say like, okay, $200 a month? Same male, 32 years old. Well, now you can see the amounts are jumping up considerably. So yes, cumulatively, you're paying $24,000, 2,400 a year, excuse me. And we cut it off at that same 20 years, which means that cumulatively over that 20 years, you paid $48,000 into this, but now you made at that same point $60,000. So now you're ahead. And if you wanted to hold on to this policy until retirement, then you'd have about $150,000 to supplement your retirement. Now, once again, the money in that cash value, you can access it anytime. You can use it, you can take out money to say, okay, I need $10,000 to do whatever, I need 15,000 to do whatever. You always have access to that money. The only thing you have to do is notify me, notify the company, and we would go ahead and generate that loan. Now, I mentioned that you take it out as a loan. As a loan, you should probably pay it back because if you pay it back, you're not going to affect the policy at all. But the way that these policies work, if you don't pay them back, it's also okay. You don't have to, you're not required to pay the policy back. The only thing that's going to happen is you're going to decrease that amount in the death benefit. So, say you take out like $20,000 in year 20, all it's going to do is they're going to take that $20,000 off of the death benefit. So, you have access to that money, but you don't have to necessarily pay it all back. Okay, questions, comments on that, because that's kind of a lot. Everybody understand the chart itself as to what you're looking at.
Uh, if you have any questions, you can also put it in the chat. It looks like nobody has questions. It looks very clear to me, but
Mhm.
I know somebody just
Okay.
came in, but yeah.
Okay. Not a problem. Yeah. So, because this is the important stuff. I mean, because when you build up that cash value, I just want you to know that yes, you have access to it at any point. If you want to use it for retirement, great. If you want to use it for anything else, that's also great. And again, this is only paying $200 a month for 20 years.
So I do have a question that, for example, age
Yes.
67,
Yes.
um, because I'm reaching there, but 140, so the cash value and the benefit, the death benefit is different. And so if
Yes.
somebody was to pass away, that's the amount that could go potentially to my special needs.
No. So, okay, if you were to pass away at 67 and you have not taken out any loans at all, your beneficiary is going to get that full 175. Okay.
Right.
If you've taken a loan out, then it's going to be the 175 minus how much you took out and didn't pay back.
So and so the cash value also goes down, I would imagine, right?
Correct. It also goes down.
Okay.
Yeah. So, yeah, you're correct on both points. Yes. So, if we were to kind of take a look at this another way, this is the same thing, same $200, same 32-year-old male. And you can see at age 50, you've paid in about $43,000, but you have $53,000 in that cash value built up. At age 60, you can see at age 60, you're done paying it. You've already paid in all you're going to pay into it. You've like doubled your money. At full retirement age, you're sitting in about like a little bit over $170,000. So again, you have access to this money at all points, and you can see that the money does grow. Now, bear with me for a second. What if I were to take the same concept and use it for a minor, somebody that's say under 18 years old, and I take this same $200 a month and I apply it to a policy for a kid? Well, at that point, congratulations, you just made your kid into a millionaire. Okay? Because at that point, now I did stretch it out a little bit more because since it's a kid, I did for 30 years as opposed to 20 years. But you can see that the cash value has grown. It grows a lot, when you apply it to a kid. What does the chart look like on that? It looks like that. So you can see again, you paid 30 years into this thing. At that point, you stop paying it. Your child is still in their mid to late 30s, but they have about 100,000, $142,000 they could use, or in their mid 40s, they got about $200,000. So that kind of answers the question, when your kids say, "Hey, how do I buy a house?" Well, this is a great vehicle. This is something that you paid into $200, a month over a period of time, and it's a finite period of time. So this is something that, it's a great vehicle for kids because you can build up lots and lots of money. And again, if you hold on to this until retirement, now they have over $1 million they could use in their retirement tax free. So that's something that you also may want to consider. Another point too is that you may want to consider, and this is something that some families have done, is to combine the cash values in a policy for, like, say, one policy for mom, one policy for dad, another policy for their minor child. So now you have the cash values from all three policies that you can have access to and do whatever. Again, you could buy a car, you could buy a house, you could buy whatever. I mean, that money is available to you at any time. So that's different strategies that families have done to kind of pool the money to, make better access of it. So again, it's lifetime protection, I mean, it's these policies are designed to last for your entire life. You have the potential to build up wealth and you have access to those funds. It's very flexible. Like I said, there are no credit checks, there are no requirements. As long as there's cash value in that amount, then you have access to that. You could take that out. So that makes it a really, powerful financial tool. And again, it is at heart a life insurance policy. So you will be leaving that legacy for your family. It will cover your final expenses. It'll help to cover your final expenses. It'll help to transfer wealth from you to your beneficiaries. And it just creates that peace of mind. So it is, like I said, a life insurance policy at heart.
We
So, mhm.
we have two new people. I just kind of like if you maybe just talk a little what the
Sure. Let me go back a little bit for the new folks. Okay, so basically what we're talking about is we are talking about an IUL or Index Universal Life Policy. What the benefit of this policy is that it builds up cash value. The cash value is accessible to you in the form of loans whenever there's cash value available. So if we go back, and we say, okay, there's a mail that you put in $100 a month for 20 years. So the first year you're going to put in $1,200. That's $100, times 12, that's $1,200. And if you look at the cumulative amount, it goes up, so we get to year 20, you've paid in cumulatively, say, paying that same $100 a month, $24,000. At that point, what I'm suggesting that you do is stop paying it, because the policy has enough money in there where it's still going to generate funds. It's still going to like increase that amount in the column that says cash is the cash value. That's the amount that you have access to at any time. Anytime there's money, you have access to the money in that cash value amount. So that's at $100. If you look at like $200, you can see that it builds up a lot more. So you paid in now cumulatively over 20 years, you can see you have access to, you paid in cumulatively $48,000, but you've made $64,000. So you've increased your money by 20,000. And again, if you hold on to that until retirement, then you would have about maybe 150, that you could use in retirement. And what I was just talking about is that if you were to apply the same model to a child, say like 8 years old, instead, now you can see the numbers jump up a lot. You're still paying that same $200 a month, but since they're younger and it has more time to build up, the cash value builds up a lot. So now the child, as when they're in their mid 30s, they have about $100,000. In their mid 40s, they have about $200,000 that they could pull from. If they were to hold on to this money until retirement, now they have about $1 million to supplement their retirement. But again, you have access to that money at any point in time that you want to use it for whatever you want to use it for. So that's a brief recap of the things that we've kind of went over.
there's a
Uh,
question in the chat.
yes.
It's but if it's a loan, when do you take money out? Does it paying back? What does it paying back look like? I guess.
So as any loan, you can pay it back. It's basically the loan rate is about 4%. You can pay that back, but not to get too wonky. You don't, you're not required to pay it back. So if you were to say like take out of like in this example right here, if you were to take out like say $20,000 in year 30, then it's going to happen is it's going to decrease that death benefit by that $20,000 if you don't pay it back. So you should pay it back, but you don't have to pay it back. You're not required to pay it back. So does that answer the question, or did you have a follow-up question?
So what happens to the interest that,
Okay, that's going to get a little bit wonky, but let's say, let me explain it to you like this. When you put money into the policy, it builds up in the cash, it builds up in the cash value. So there's an interest rate in that cash value. There's an offsetting interest rate that the policy is growing by. So they kind of zero each other out. So that's why you don't necessarily have to pay it back. When you take out that loan, the insurer is using the actual policy itself as collateral. So the interest rates zero each other out. I mean, but again, that's a longer conversation. And I'd have to kind of get into numbers on that one, but just know that it's basically the interest that's accruing in the cash value and the interest that's accruing in the policy itself, kind of cancel each other out. So it, yeah, that's why you're not required to pay it back.
Oh, okay. So I have kind of something to add to that to ask.
Sure.
So does that mean that's based on the market value and what the interests are at that time? If can those be different, and how does that affect it? Is that like does the my
The
question make
short
sense?
answer is no. The loan amounts are based on the market value. The only thing that's based on the market value is the accrual of the cash value amount. That's based on the what the stock market is doing, and what index fund it's tied to is doing at that time. But the loan is not based on the market value. No. So I don't know if you heard before, but what happens is you have the cash value is going to grow based on whatever the market is doing. So if the market's going up, it's going to grow. And it's going to grow pretty much like that. But it has a floor. The floor is zero. So that means if the market goes negative, then it's going to level off. So you're not going to grow that during that period. And then
So
once it
then you
starts growing again, you're going to grow some more.
all right. So then you won't lose it. Like this is not like something that you would lose if the market
That's
value just
exactly
crashes.
correct.
It just stays stagnant.
That's exactly correct.
Okay, great. Thank you.
So a lot of people compare these to like say IRAs or 401ks and things. And if you have an IRA or if you have a 401k, you probably don't want to look at it right now because the market's been ugly. I mean, it's been really ugly, so it's
Yeah,
no fun. But yeah, so that's the benefit of these type of policies.
great. Yeah, that was my big concern, but thank you. That's relieving.
Okay.
would it make sense to go into one of these type of policies when you're like my age, like 60, you know?
Yes. So it would make sense. It just realized that you probably gonna have to put in a little bit more. So you're probably not going to get the returns that you want to get by doing maybe $100 a month or $200 a month. So I do have somebody around that age right now. They did a policy about in 21. They went about $400 a month, but in 5 years, that policy already has about maybe $20,000 built up in the cash value column.
I have another question. I'm sorry.
Sure, go
Are
ahead.
we able to transfer these like or sell it to or transfer it to somebody like through
Transfer
sell?
it in what way?
Um, like for example, if I want to transfer it to who's going to be the conservator of my child or to my child, and then just pay for them if I
Okay, so
started.
no, at that point, what you want to do is you would want to make the trust a beneficiary,
Okay,
and those funds will be paid out to that trust.
okay, that makes sense. Perfect. Thank you.
Okay, let's see.
I think that does
Yeah,
anybody else have any other questions? We can even finish early.
Okay, let me get down to here. Okay, RVs are right for everybody. The design and the fun didn't matter, because we would need to sit down and design something that would be meet your goals, but also would be within your budget. Because it's not going to do anybody any good if we try to put something together that's going to be outside of what you can comfortably pay. And so, and then also these are not get rich quick type things. You're not going to make a bunch of money overnight, so that's where education comes in. So that's why, it's great if we sit down and talk about what goals did you have and what were you looking to do. And yeah, that's how we come in, Larry Baker Insurance. Basically, yeah, we will design the policy because we want to make sure that we design the policy that it's going to be as beneficial to you as possible. So if the goal is to maximize the cash value amount, we're going to design it one way. If the goal is to have the highest death benefit available, then we're going to design it another way. Because we want you to be able to reach those goals, and we want to, have that long-term relationship. So, when you have questions about it, because I get people all the time, it's like, hey, I have money in this. How much can I get out? So we'll look it up and say, okay, you have this much available. You can take this much out if you want. And that's the kind of like things with that we'd like to, sit down with you and kind of develop.
I have a
So,
question. Can
yes.
I forgot what I was going to ask you now, but it's with this life insurance, because mostly with life insurance, any policies or they want like a health check and things like that to be able.
Okay. Great question. So, in the past, yes. Right now, we just went to an electronic application. So basically, what it is I would send you a link. You would fill out the questions in the link. It's about maybe I think 9 questions or 10 or something. And then it'll kick back the results. So for the most part, we are not doing paramedic exams anymore. Okay, it's just fill out the questionnaire, submit it, and we'll see what they come back with. The great thing is that I've seen a lot of policies come back where somebody's submitting the policy and they want maybe to get it cleared for $200,000, but it will clear up to 2 million. So all of a sudden now we have options. We can say, okay, we can do a lot of different things at that point. But yeah, no, we've got for the most part we've gotten away from paramedic exams.
So to uh, go on that,
Mhm.
so then there's a way that when we answer those questions, I think that there's databases that you guys can check and things like that, right? That brings
Yes,
back an answer,
yes.
right? Yeah.
So it's
Okay.
the medical records database that they access.
Okay. Thank you.
Hmm. Okay. Any other questions on that or anything else? Mhm. Okay.
Yeah, I have one
So
more. I'm sorry. So is this
sure.
considered like a whole life, a whole, what are they called?
This is
Or is
actually
it-
in
or-
the family, but it's not whole life. So whole life is it's similar, but the because whole life actually does have a cash value, but the cash value builds up a lot more slowly because of the way it's structured and interest rates. So generally speaking, whole life it's not a bad product. It's just not the same. This actually builds up a lot faster because the whole life is not tied to the stock market. These are.
oh, okay. I have another question too. I have a term one, that
Yes.
I've been wanting to kind of upgrade. So I've been wanting to get rid of it because I wanted to go to either one of these or to whole.
Mhm.
How do you know how I would would I be able
Okay,
to do
so
something like that?
if we have, like, say, if you're looking at one of our policies are convertible. So if we have a term policy for you, and a lot of times it makes sense, because term policies are usually less expensive. we can convert a portion of that or the whole thing from the term policy into an indexed universal life policy or a whole life policy. So we have that convertibility. A lot of carriers do not have that convertibility, so you are kind of stuck, you know. Now, if you have a policy, I don't necessarily suggest that you get rid of it. You know, I mean, it just because it's kind of like things change, you know, your economic needs change and stuff, so you never know when that may be necessary. So I don't know if I'd necessarily say get rid of it, but I would say that you probably look to either convert a policy or to start like say a new term that you would convert at a later date, or just start straight into like an index universal life policy.
I see. So then once the term is up, then I can consider getting one of these. But I shouldn't like just stop it just for the term. I think I have like 5 more years or something like that.
Yeah, I probably would not stop it. You know, I mean, there's no real need, you know. I mean, it just again, it all gets down to like trying to, design something that's going to be in your price range that, that's not going to be too painful for you. And that's where I would like, kind of put that together. But I never really like to see people get rid of policies that are enforced because you never know. You know, it's always a lot of times more is better. You know,
Oh, okay. So let's say if I okay, so let's say if I wanted to start one of these index ones,
yes.
can we start at a lower rate so like that it could, it wouldn't be
So,
so overwhelming paying both, and then can you increase it later once my term is over, and then I can just put
mm,
more money into the index? Can that
yes.
happen?
Yes, so you can do both. So the illustrations that I was showing you were about $100 a month. You
Mm-hmm.
could start lower on those policies. I don't normally suggest it, because the problem that most people have is they'll start lower and then they never increase the value. So by the time you get 20 years in, um, it's the policy itself is going to probably run out of money, because you didn't start off with more. But you could always put more you could always, put more in. So say like we design a policy that's $100 a month, and you have some good years in the beginning or somewhere in the middle, and you say, hey, I want to put $200 a month in for the next 2 years. You can do it. There's no penalties, there's no issues. The only thing that's going to happen is your cash value is going to start growing faster than what we illustrated.
Okay, okay, great. Thank you. It's been good information.
Okay. So at that point there, let's talk. I mean, because there's no pressure. And like I said, I would love to sit down and just discuss, ideas with you. And the great thing about the electronic application is that once we get that thing submitted and it gets approved at a certain amount, now we have options. You can decide, okay, I want to do this amount, or I want to do this amount, or I don't want to do anything at all, but I still have that option. So that's, the point that I'd like to get you to.
You able
Go
to
ahead if you.
send, oh, are you
Yeah, go ahead.
a link or something and then they can take a look
A link to what?
to the application that you talked about?
No, because I have to send it out. I have to do it per person. So you'd have to like, you would have to reach out to me. I would need like, just the basic information. I would need your full name, address, date of birth, social security number to put that in the system. Then I can send you, and or email, and then I can send you out the link. I mean, once I get that in there. But yeah, I would
Okay,
need that basic information.
so we can email you and or call
Yes.
you, and then this is how we would
Yes.
begin. Okay, thank you.
Yeah. Yeah, so that I mean, and it's literally like it used to be a process where we would take like I don't know, it would be like maybe 2 weeks or something, and now we can actually do a lot of these on the same day. So Once I get the information in there, then it would just be a matter of just sending out the link. Let's see. I'm looking there was a few questions. I think we got them though. Okay, so there's a question there. How does the beneficiary access the late parents policy if they don't have any information about the policy? The beneficiary, what's going to happen is that, okay, so say the person passes away and they name their child as a beneficiary. What's going to happen is we're going to start looking for that person. In the agency itself and also the underwriters in the company itself, they're going to start looking for that person. And once they find that person, they're going to let them know, okay, we have this policy that you're a beneficiary of, and you have access to all the proceeds from that policy now. So yeah, it's that's why we usually try to get as much information on the beneficiary as possible. So we try to get like address, phone numbers, possibly social security number for the beneficiary, because it makes it that much easier for them to locate them after the fact.
So
Uh,
would you know somebody passed away without somebody telling you they passed away? I'm just
would I know if somebody passed away? No, but I know that I've had the kids of people that have passed away reach out to me and ask me, "Hey, did this person have a life insurance policy?" And then I can look it up and say, yeah, they had one, or no, they did not have one. And if they did have one and this person listed as a beneficiary, then we go ahead and we get them started on getting the payout. So generally speaking, yeah, no, we don't get any kind of like, unless a family member lets us know, we don't really have any like forewarning that, that somebody's passed away.
I put in the chat Larry's information in case you're interested. You can copy it or you can take a photo of his information on the screen. Um, if there's any other questions, do you guys have any other questions? Otherwise, do you have anything else, Larry?
No, I mean, it's like, again, I really thank you for the opportunity to kind of to talk to you a little bit about it. I mean, these are something that I just really, really believe in. I mean, if you look at everybody in my office, everybody that has kids have one of these policies.
Mhm.
Everybody in my that have a kid, because it's probably one of the easiest things you can do to kind of build up, money for them so they have, a good financial, groundwork to kind of move forward in life. So it's something that we really believe in, and it's something that I would love to share with you.
Thank you so much. Well, thank you so much, Larry, for giving us your morning, and thank you everyone for joining us. And we can start the rest of our weekend. Thank you so much, and have a great weekend. I'm gonna stop the recording now.
Thank you.